Our next guest says positive momentum is still strong and that the Fed should stop raising rates. Wharton School Professor of Finance Jeremy Siegel joins us now. You've been saying this for a while, Jeremy, and it doesn't feel like they're listening to you because what we get is still a lot more hawkish Fed speak. And now there's this idea that I talked about this morning that they're talking a little bit about, which is that we can't necessarily assume we've seen the last of inflation. It could bubble back up. Our economy is still doing okay. Why is that wrong?
Well, I mean, it's a Goldilocks economy. I mean, strong economic growth and falling inflation. I mean, you hit it yesterday. I mean, Sarah, I looked at the jobless claims dropping, so that temporary weakness that we saw, earlier this month looks like it's disappearing. However, I don't see any reappearance of inflationary trends. I see stability. Oil has got its footing. Commodity index have sort of stabilized. The housing market is stabilized, but I don't see anything that big inflationary uptick. I'm not concerned about today's University of Michigan. It was taken before, before the news came out on the CPI and the PPI, and when we had CPI year over year down to 3% and core under 5%, we got headlines in all the major newspapers, and that's what really affects that consumer expectations.
Brent crude is back up to 80. It's rallied even in the face of weaker Chinese data. Some of the other metals have rallied as well. Housing is now on the rebound, and we know that's an important one for the Fed. And the consumer's in decent shape, we're told by the bankers this morning. I mean, isn't it the wages and the fact that there's a lot of demand for labor that even if it's softening is still showing 9 million job openings? Doesn't wouldn't that make you on guard for inflation coming back up?
You're right on this, on the commodities. The housing has hooked up. There's still not a lot of transactions. A lot of them are cash transactions. We know that the 30-year mortgage is going up to 7 3/8, and so that's going to be somewhat of a problem for those that have to finance their home. I mean, those things definitely have to be considered. I think it's wrong to target wages. Wages, as we've mentioned, have fallen behind inflation since the pandemic. They're in catch-up mode. We need to bring people into the labor force. I don't think they've been the source of the inflation. So I think it's wrong to say it's almost like they're targeting real growth and against the wage growth that is necessary. But I agree with you. You got to look at those commodity markets. They have stabilized. If they start going up again, then clearly the Fed has to stay on guard. Listen, I think in a week and a half, we're going to definitely have another quarter point. That's baked in. What happens in September depends certainly on what's going to the evolution of the data over the next 6 weeks after that. We also have to take into account that James Bullard, surprise retirement, one of the most hawkish members, although his counterpart at the Federal Reserve, Waller, on the board is very hawkish. As well as several others that can certainly take his place on the committee.
And they've been right. The hawks have been empowered by the data because the economy is not falling apart. And yes, maybe we haven't felt the lags, and clearly everybody's a little bit worried about that.
I still say the lags, you can't ignore them. I know that several Fed officials said, we don't have lags anymore. Well, hey, take a look at their decision on tightening for inflation. Between that surge of money that started on the month of the pandemic, March, and continuing next year, we didn't get that surge of inflation till 2021. So I don't think lags are, dead and gone the way some Fed officials have said. And that's what worries me. I still see those downside risks. I'd much prefer to let a couple of these pass and see really what happens before I start hiking again. But nonetheless, the Fed might stick the landing here against all expectations, to use that Olympic term